Hello, I think we are live now. Hello students and welcome back to bankexamstudy.com. My name is Ramandeep Singh and this is the session number 29 for the SEBI Grade A 2020. So today I'm going to discuss very important questions for the final accounts. Let me just share the link to this live session on my Telegram channel. So give me a minute before we can actually share the link to the Telegram channel before we can start. So I'll be sharing 10 important questions, right? So let's just start now. Accounts. Yep, everything is working properly. So it's time to share the link on my Telegram channel. So it goes here. So we are live. We are live now. So I'm working from home, so there might be some disturbances in the background. Tongue twister. So anyway, certain fundamental accounting assumptions. So there are three accounting assumptions. Which of the following are not fundamental accounting assumptions? While preparing your financial statements, there are certain you can make certain assumptions, right? There are fundamental accounting assumptions that are not specifically stated, but disclosure is necessary if these fundamental accounting assumptions are not followed. Disclosure is not necessary if you are following those, but if you are not following one of these three assumptions, then a proper disclosure is required in the final account. So which of the following is not an accounting assumption? One of the three accounting assumption. If you know the correct answer, just let me know. So 12 students are live with us. Hello everybody. I'm just reading all the comments. So somebody is telling me derealization concept, Sundar Ravi, and you are right. For the commerce background student, that this lecture might be very boring, but for others this is interesting. So there are three accounting assumptions: the going concern, consistency, and accrual. Let me explain the meaning of these concepts, the assumptions. The going concern: when we start a business, we assume that we are going to continue this business for a long term, right? That is why there is a concept of depreciation, right? So why there is a concept of depreciation? We buy a good, let's say for 100 rupees, then we are going to charge depreciation at 10%, okay, every year 9. So that's how we do. Why we are doing this? Because we assume that we are going to continue the same business for a long time. There is a going concern concept, okay. And then consistency. The accounting policies that you are using in one financial year, the same accounting policy you are going to use in the next financial year, right? If there is any change, you need to make a disclosure. A classic example is depreciation. So there are, let's say, two methods to calculate the depreciation. The value of product is cost is rupees 100. In the very first year, depreciation charge is 10%, right? So this is straight line method, SLM, and this is written down value method. So 10%, okay. The value is 90. Under the straight line 10% again. So value is 80. But now the 10% of 90 rupee is 9. That would be the depreciation that would be charged. Okay, so that's how the depreciation is calculated under straight line method, and that's how depreciation is calculated under written down value method. So if you are using written down value method, you cannot switch to SLM, and if you are calculating the depreciation according to SLM, you cannot calculate according to written down value method. If you are changing it, obviously you are trying to misrepresent your final account. You want to misrepresent your profit and loss account. There is a problem. So accrual concept, just a second. So accrual concept, see students, let's say you just a second. Okay, I can't help it, sorry. So accrual concept, let's say the interest, you took a loan, right? That took a loan and interest the interest accrued is 31st of March, right? And let's say you made an investment, interest accrued is on 31st of March 2019, but you received the interest on 5th of April 2019, right? So in which year? 2018-19, 2019-20. So for which year you are going to charge the interest, right? So as the interest accrued in the 2018-19, it should be charged to that year, not when received. The balance sheet is not prepared on cash basis. The balance sheet and the final accounts are made on the accrual concept, right? When they actually accrue, not when you actually made the payment or received the payment. That's what this concept is. Very easy. Simple concept. Try to understand the concept, then the life would be very, very easy. Okay, super easy. Let's move forward. Anyway, Banu Soni, that's my number actually. Okay, thank you everybody. Let's move forward to the question number 2. The basic concepts related to balance sheet. There is cost concept, which the basic are cost concept, business entity concept, consistency, both A and B, both B and C. So which are the basic concept? The basic point of doing this lecture is to tell you the meaning of these these concepts. Actually A and B, the cost concept and the business entity concept is actually correct, because this consistency is an assumption. Consistency is an assumption. It is not a concept. It is an assumption. I have already explained this. Now, what is business entity concept, right? Let's say Guru Infotech, that is the brand, the name of company under which I make my final accounts. So, although I'm a sole proprietor, I'm the single owner of bankexamstudy.com, right? And it's under Guru Infotech, but Ramandeep Singh and Guru Infotech, these are two different entities, right? I mean, so let's say this is a Guru Infotech LLP. So this LLP and Ramandeep Singh, we are different entities. Even if it is a sole proprietorship, I'm considering it a different entity. That's why there is a capital account. Whenever I draw money from my business, it is mentioned as drawings. So business entity, your business, and you are different entities. And you have your own account in your balance sheets. There is a proper account of yours in your balance sheet. And the cost concept, what does the cost concept says? The cost concept requires the transactions to be recorded on the book value of the at the amount which are actually involved. So you should not consider the market value. If the market value of the fixed assets you purchased is higher than your cost, you cannot consider the market value. Okay, so it should be market value or cost, whichever is lower. So gross profit is equal to, very, very easy question. I know a lot of you are going to tell me, sir, this is super easy. There is nothing in that, but very important. The gross profit is equal to what? The gross profit is equal to what? It is obviously not the thing. So gross profit. So it is not here, because what about the direct expenses? Direct expenses का कोई treatment नहीं है. What about direct expenses? It's not mentioned here. No mention of direct expenses here. So the sales minus the cost of goods sold. This is a simple formula. Cost of selling the goods. Okay, very simple. Now, what is the difference between revenue expenditure and capital expenditure? Revenue expenditure and capital expenditure. These are two types of expenditures: revenue expenses and the capital expenses. See, student, revenue expenses, if you can allocate the expense to 1 year, to one particular year, right? Let it be wages, let it be any maintenance. Okay, that is revenue expense. If you bought if you need to split over a period of time, 4 years, 5 years, 2 years, then it is a capital expense. Mostly it is purchase of land, purchase of machinery, purchase of fixed asset, right? So which cannot be a revenue expense. Interest on loan, obviously interest on loan is for 1 year only. So this is the thumb rule. Wages paid to factory workers, obviously you can divide it into 1 year. Obviously you can even divide it into per day. Repairs, it is obviously on 1 year. Okay, it is 1 year. You can actually allocate to 1 year. Expenses in paid in connection with purchase of fixed asset. You purchase a fixed asset that can be used for 5 year, 10 year. You need to distribute that cost over 5 year, 10 year by the use of depreciation concept. Fire insurance is again, that is for 1 year. So this expense paid in connection with the fixed asset, D is the correct answer. It is a capital expense. You just need to understand, it can be a question in the exam, very important. What is the difference between revenue expenses and capital expenses? Revenue expenses, if you can allocate this expense for 1 year, this is a revenue expense. Capital expense, this is for more than 1 year. This is for more than 1 year. Let's take an example of fixed asset. You bought a fixed asset. Most probably you bought this for more than 1 year. So that's a capital expense. Okay. Which of the following is an example of capital expenditure? Now it's your turn. I'm looking at the super chat. Give me your answer and I'm waiting for your answer. Anybody with the answer of fifth question? A lot of you gave me the correct answer of fourth one. Expenditure paid on the replacement of a machinery. Expenditure incurred by way of fee paid to valuer, incurred to send employee abroad. Expenditure on converting business premises by switching over from manufacturing of one product to another. So which of the following can be an example of capital expenditure? This is, I'm talking about part of machinery. This is maintenance anyway, right? So this cannot be. So fee paid to the valuer of assessing the business premises. Obviously that can be, for 1 year only. You send for the training, that is for 1 year. But you send, that's a non-recurring expense. A capital expenditure is a non-recurring expense. You just converted the whole business premises. So that is a capital expense. Okay. That's a non-recurring, whose benefit lasts for more than one accounting year. I already told you, I already taught you. Which of the following won't appear in PL and account? See students, there is a trading account to calculate. There is a trading account, and to calculate, gross profit, there is a trading account. And then from gross profit to calculate net profit, there is P&L account, right? So in the trading account, all the sales, purchases, sales return, purchase return, and the direct expenses are recorded. While in P&L account, there are indirect expenses, right? So which of the following won't appear in PL and account? Give it a close look. Bad debts. It is an expense, right? The provision to buy bad debts is created. So its effect is in the P&L account. Yes, accrued expenses, it's there. Salaries, depreciation, obviously they are there. But what about the drawings? The drawings is there in the balance sheet. It is there in the balance sheet. It is in their balance sheet, right? Please check the video classes available on bankexamstudy.com's SEBI grade A course. So balance sheet drawings is the correct answer. The question number 7, X Limited paid salary for period ended 31st of March 2019 amounting 25 lakh rupee. The salary paid in respect, why it's our bad grammar. The salary paid in respect to services rendered during the year 2019-2020. Okay, it is for the previous year. Salary outstanding is 2,50,000. Okay, for the year. So what about the accrual concept? So the total salary accrued is 27 lakh, 25 lakh is actually paid, and this much is pending. So accrued value is 27 lakh and 50,000. That much is actually accrued for the previous year. The final accounts are not made on the cash basis. These are made on the accrual basis. Super easy. The manager of X Limited is entitled to a commission of 10% on net profit after charging such commission. Very important question. I'll give this question 3 star. All the question, wherever I'm giving the 3 stars, these are very important. You are going to find such questions in your exam. So this particular term is very important. 10% on net profit after charging such commission. This particular wording is very important. After charging such commission. Are you getting it? After charging such commission. That means what? That means after charging 10%, right? It's like, let's say the total the sales is, let's say, after charging 10%, the manager, the X Limited should get 100 and the manager should get 10. So after charging the commission, the X Limited, the manager should get 10% after charging the commission. Are you getting it? After charging the commission, the manager should get 10%, the X Limited should get the 100 and the manager should get 10, right? So you can find out the ratio. The X Limited should get 10 and the manager should get 1. Okay, so after charging, this is very important. If this term was not there after charging, then manager would get 1 and the X Limited would get 9. But here the story is different. He said after charging such commission. So once this commission is charged, the X Limited should get 10 and the manager should get 1. Okay, that's so net profit before charging such commission is 1,40,000 and the manager should get 1 and X Limited should get 10. So it's 11. The total is 1 plus 10 is 11 and the manager's share is 1 over 11 and the company share is 10 over 11. Okay, very important. So you can easily calculate it. You can just divide it, right, and you can get the answer. Okay, so what's the correct answer? It's 12,773. So you can just find it out. The 12,773 and the cut of the company would be 12,773 0. It might be like that. Okay, so that might be for X company and that is for the manager. Okay, so after charging such commission, it should be 10% on net profit after charging such commission. Are you getting it? Very easy. It's similarly, it's explained here. So profit and loss account shows what? It shows the financial position, the balance sheet. The balance sheet is there for the financial position. Obviously, the first one is out of the picture. The balance sheet states the financial position. The financial results are depicted by, for a particular period, is depicted by the profit and loss account. Okay. So, which of the following is not a deferred revenue expenditure? Deferred revenue expenditure. Did I tell you that all the expenses, right, revenue expenses can be, charged for one single year, but there are exceptions. Deferred revenue expenditure is an exception. This is a kind of a expenditure, right, which you need to split over a period of time. This is known as a deferred revenue expenditure. Many times it is confused with capital expenses, but it is deferred revenue expenses, right? So for example, the advertising fee, you paid it in 1 year, yeah, right? You paid a huge amount in 1 year, but the benefits, you made a brand, the benefits you are going to get in next 2, 3, 4 years because you build a brand. The same goes to in the preliminary expenses. You set up a company, the benefits you're going to get in the next 4, 5, 10 years. The expenses in connection with issue of the equity share, the benefits you are going to get in the next many years. But what about this one? The expenditure incurred in converting business premises by switching over from manufacturing of one product to another. So you just switched from one product to another. There is another example, similar example in the previous question, but quite different. So instead of producing one product, you are producing another product, and you made some changes in your manufacturing process. The expenses that occurred here, that is not a deferred revenue expense, that is a revenue expense. So A is a correct answer. So that's all for today. I hope you like the today's session. Very, very easy. You can join my full course in which I am providing the conceptual video classes, the notes, the complete videos courses there based on the latest syllabus. Test series is included. Downloadable notes are there. These notes are available in the print friendly format. You can download the PDFs, you can take the printout. Descriptive paper evaluation is there. Last year we got 9 final selection in SEBI grade 8 2018. You can just join the course and bankexamstudy.com. This is my WhatsApp number. If there is any doubt, you can always ask your doubts in my WhatsApp number, right? So that's all. This is a list of students who cracked the SEBI Grade A 2018, IBPS RRB GBO Scale 2, Scale 3, Bank of Baroda Wealth Management, NABARD Grade A. All these students, they used our study material and they finally cracked their respective exams. And I'm really happy for them. So that's all for today, students. I hope you liked the today's session. If there is any doubt, you can always ask me your questions on my WhatsApp number. Just subscribe the channel, like the video, and post your doubts in the super chat, in the comments as well. Anyway, I have gone through your super chats. I don't think there are many doubts. Last answer was wrong. Somebody's asking me last answer was wrong. Please give it a look. Give it a look. The last question. Expenditure incurred in converting business premise by switching over from manufacturing of one product to another product. This is not a major change. You didn't break anything. This is not a major change. You just change the manufacturing from one product to another product. That's all. That's all. I mean, in the previous examples, I guess there is a similar example is there. It is there. See, a capital. This is little confusing actually. This is actually a capital expense. Capital, and I'll confirm it, okay? Quite similar. Expenditure incurred in converting business premise from this is not a deferred revenue expense. This is a capital expense, I guess. Okay, this is a capital expense. I guess you are right. This is a capital expense. This is a capital expense. This is not a revenue expense. A is a capital expense. This is not a deferred revenue expense. So that's all for today, students. Please subscribe the channel. If there is any doubt, you can always ask your doubts in the super chat. So thank you and have a very nice day. Good night.